Welcome back to the Deep Dive. Today is a really important session for us, and honestly, for anyone holding a crypto portfolio right now.
Yeah, absolutely.
We're stripping away the noise today and speaking directly to our family here at My Crypto Paradise. We aren't just looking at candles and lines. We're actually stepping inside the mind of the Paradise team's lead trader, Simon.
Right, which is exactly what we need right now.
Exactly. And let's be real for a second. If you have looked at your phone or checked your portfolio or even just turned on the news in the last 48 hours, you are probably feeling that specific tightness in your chest. You know the one I'm talking about.
Oh, I know it. It's totally visceral. I mean, the sea of red numbers, the panic in all the group chats, it triggers a very primal fight or flight response for most people.
It really does,
Yeah.
because Bitcoin is crashing. The headlines are screaming about geopolitical conflict escalation, Israel, Iran, the U.S., and obviously, we aren't taking any political sides here. We're just reporting on the ideas in our source material, but it feels like absolute chaos out there.
It does feel like chaos.
And this is exactly why we do these deep dives. We have a source today, Simon's latest Saturday update.
Yeah.
And it completely flips the script on all this panic.
It really does. And frankly, this discussion today isn't just about whether Bitcoin is going to 44,000 or bouncing back to 60,000. It's really a masterclass in psychology.
Yeah.
We are going to break down the distinct difference between a gambler who is currently sweating over every single news headline and a professional trader like Simon, who is actually looking at the structure of the market and finding clarity in it.
That is the mission for today. We are going to decode Simon's wisdom. We're going to look at why humans are biologically wired to lose money in crypto and how the Paradise team protects us from our own instincts. So let's just jump right in.
Let's do it.
The crash. Everyone is talking about the news. It feels like the world is ending. And naturally, Bitcoin tanks. It seems like a very simple cause and effect, right?
Well, that is the instinctive human reaction. In behavioral science, we actually call this the blame game.
Blame game.
Yeah. When we feel pain, specifically the financial pain of seeing our net worth drop, our brains desperately search for an external cause. We need a scapegoat.
Right. We need to be able to say, I didn't make a bad trade. The news caused the market to crash.
Exactly. It absolves us of responsibility and preserves the ego. But Samparan calls this out immediately in the update. He asserts that this is simply false. The news regarding the geopolitical tensions, it didn't actually make the market move.
Okay, let's unpack this because this is a huge concept for people to wrap their heads around, and it feels counterintuitive.
It does.
How can he say the news didn't cause the crash when the crash happened exactly when the news broke?
Think of it this way. Simon uses the concept of a catalyst. Imagine you have a massive pile of dry wood and gasoline already stacked up.
Okay.
That structure is built, it's unstable, it's ready to burn. The news is just the match. The match doesn't build the bonfire, it just ignites what was already there.
That is such a great analogy.
Yeah.
So the market structure, the actual technical setup, was the pile of wood.
Precisely. Simon points out that the move to the downside was already technically inevitable. The market was in a pattern, specifically a skewed triangle, which we will get into shortly, that naturally resolves to the downside. The destination was already set.
So what did the news actually do then?
What the news did was provide the speed.
The speed. Okay, explain that.
Well, bad news creates panic. Retail traders, the regular folks who aren't in the Paradise team, they see the headlines, get scared, and sell immediately. They don't look at price action, they just want out. That panic selling provides liquidity.
Liquidity. That's the magic word Simon uses a lot. So the bad news actually helps the whales, the smart money, execute their plan.
It sounds cynical, but yes, that is how the market works. If you're a whale holding thousands of Bitcoin and you want to sell, you can't just dump it all at once on a quiet Tuesday.
All right, you'd crash the price before your order even filled.
Exactly. You need a frenzy, you need volume. So when the news hits and retail panic sells, it creates a massive pool of orders that the whales can sell into. The news acts as a catalyst to provide that extra liquidity to make the move happen faster. But Simon is adamant about this. The move would have happened anyway.
That is wild.
Yeah.
So while everyone else is glued to the news feed, stressing out about everything, the professional's looking at the chart and saying, yep, we were due for this drop regardless of what happened in the news.
Exactly. And that brings us to the core trap that caught so many people before this crash. Simon analyzes the sentiment right before the drop. Do you remember where we were just a few weeks ago?
Oh, I definitely remember. We were pumping. Everyone was calling for new all-time highs. It felt totally euphoric.
Right. The fear and greed index was sitting at 80. Extreme greed. Simon noted that retail investors were basically smashing the buy button.
And usually, I mean, in the regular world, if everyone wants something, the price goes up. In trading, that's a trap.
It is the ultimate trap. While retail was buying with extreme greed, Simon noticed something crucial on the order books. The big boys, the whales, they were distributing.
Distributing, meaning they were selling.
Correct. They were offloading their bags. And here is where that concept of liquidity comes back again. Whales have so much Bitcoin that if they just sold it all at once, the price would collapse instantly. They wouldn't get a good price.
They need the retail greed.
They desperately need it. They need a frenzy of buyers to absorb their sell orders. They basically need someone to hold the bag.
Wow. So when you're feeling FOMO and hitting buy because you think it's going to the moon, you're essentially just becoming exit liquidity for a whale.
That is the harsh reality. And Simon saw this coming. He looked at the leverage. When sentiment is at extreme greed, people aren't just buying with their own money, they are borrowing money to buy. High leverage.
And high leverage acts like rocket fuel.
Right.
But it works both ways.
It guarantees volatility. It guarantees that when the move happens, it will be violent. Simon looked at the insider data and the indices and determined that the probability, not the certainty, but the probability was that this volatility would break to the downside.
So it wasn't just a guess.
Not at all. It was a probability point system.
I really love that phrase, probability point system. It takes the emotion right out of it. It's not about feeling lucky. It's strictly about math. And that leads us perfectly into the mindset aspect, because Simon said something in this video that I think should be tattooed on the forehead of every crypto trader.
No, I know the quote you're talking about.
Yeah, he said, "I am not a money-making machine. I'm here to make sure your capital is safe."
That right there is the My Crypto Paradise philosophy in a nutshell. And it is so rare in this industry. Most gurus or influencers are just hyping the next coin, promising these crazy 100x returns, basically telling you to mortgage your house. But Simon sees himself as a shield.
A shield for our wealth.
Yeah.
I really like that. But it's hard, isn't it? It's incredibly hard to sit on your hands when you want to make money. We see coins moving, and we just want to be part of the action.
It is hard, and that is the defining difference between gambling and trading. A gambler relies on emotions, feelings, and biases. They say things like, "I feel like it's going up," or "I feel lucky." Simon says you might actually get lucky short-term with that mindset. You might catch a pump.
But long-term.
Long-term, you will lose, because the market is specifically designed to transfer money from the impatient to the patient. Simon explicitly states he would rather miss a trade entirely than risk capital unnecessarily.
That's the discipline of missing out.
Yes. Think about the concept of catching a falling knife. When the market is crashing, the amateur thinks, oh, it's cheap. I need to buy the bottom. I need to be the absolute genius who calls the exact low.
Right.
But the professional, like Simon, waits for confirmation. He is perfectly happy to miss the absolute bottom 5% of the move if it means he's entering when the trend is actually confirmed and safe.
It's just about surviving to trade another day.
Precisely. The Paradox team has actually been distributing, selling since 2023. They predicted this crash from higher levels. They aren't panic selling now because they sold when everyone else was buying. Now they are just sitting on stable coins, waiting. They aren't reaccumulating aggressively yet because the structure just isn't ready.
Speaking of structure, let's get a little technical here, but we'll keep it simple for everyone listening. Simon mentions this skewed triangle. Now, it sounds like a geometry nightmare, but what does that actually mean for us as traders?
It's actually quite elegant when you see it on a chart. A skewed triangle is a specific consolidation pattern. Imagine a spring or a coil winding up. The price bounces between two converging lines, getting tighter and tighter. It's complex, it has subwaves, but the key takeaway is that it usually resolves in the direction of the larger trend.
And since we were in a correction, a downward trend, the triangle was just a pause.
Exactly. It was the market taking a breath before the next drop.
Okay, and this connects directly to the Elliott Wave Theory he uses, right? The 1, 2, 3, 4, 5 count.
Right. Simplified, markets move in waves. Simon identified that we just finished a complex fourth wave, which was that triangle, and now we are currently in the fifth wave.
The final drive down.
Exactly. The fifth wave is the finale of the correction. And how do we know the bears are in control here? It's not just the price dropping, it's the volume. Simon points out a crucial tell.
The tell. I always love poker analogies. What is the tell in this situation?
Volume increases on the dumps and decreases on the pumps. Think about what that actually means mechanically. When the price drops, lots of trading happens. Bears are selling aggressively, dumping heavy bags, but when the price tries to recover and go up, the volume just dries up. Bulls are weak, Nobody is stepping in to buy.
So the market is shouting on the way down and whispering on the way up.
That is a perfect way to put it. The rule is you always want to be on the side of the dominant volume. And right now, without a doubt, that is the bears.
It's pure logic. Simon keeps emphasizing that. It's not magic, it's logic. It was profitable for the whales to push it down, so they did.
And that logic dictates the strategy moving forward. This is where we get into the tactical side. Currently, Simon is only using bearish tactics.
Bearish tactics. So we're talking about shorting.
Mostly, yes, or simply staying in cash, which is a valid position in itself. But if you are trading, the key is where you put your stop loss. Simon talks heavily about placing stop losses outside the noise.
Outside the noise. That's the chaotic intraday ups and downs, right?
Yeah.
Can you give us an analogy for how that works?
Sure. Think of it like standing on a train platform. The noise is that yellow line right by the edge. If you stand there, the wind from the passing train, the volatility, it can knock you over. Simon says you need to stand back against the wall. If you play too close to the current price action, the whales will actively hunt your stop loss.
They wipe you out just to grab the liquidity.
Exactly. They will wick the price up, knock you out of the trade, and then the price will drop exactly as you predicted. You were fundamentally right, but you still lost money because you were standing in the noise.
That is honestly the most frustrating feeling in the world. Being totally right about the direction, but getting stopped out anyway.
It is. So Simon suggests shorting from strong resistance levels, specifically around $70,000 to $72,000. By entering there, you can place a tight stop loss safely above the resistance. If it breaks that, you're wrong, and you get out with a very small loss. But if it holds, you ride the wave down.
And the math is heavily on our side there. That's the risk to reward ratio.
Correct. Look at the bull case right now. To bet on a pump back to the macro target of 169,000, you have to risk the price dropping to 44,000 first. The downside risk is massive compared to the immediate upside. But the bear case, shorting from resistance, you risk a little to gain a lot. The math heavily favors the bears right now.
Okay, so let's talk real numbers. We know where the resistance is, where are we actually going, what are the targets?
Simon outlines a few key stepping stones. We have support at 54,000 and 49,000. But the big one, the magical number as he calls it, is 44,000.
44,000. That feels pretty low. I mean, that feels painful for anyone holding Bitcoin right now.
It might feel painful if you're only looking at today's balance. But remember, for the Paradise team, that is the reaccumulation zone. That is the massive opportunity. If we hit 44,000, that is where the smart money steps back in to buy cheap Bitcoin for the next major run-up.
So we actually want it to go there, essentially. We want the discount. It's like Black Friday for Bitcoin.
If you have the professional mindset, yes, you want to buy low. You don't want to buy at the top because of FOMO. You want to buy at the bottom because of solid logic.
Now, I know there are listeners right now saying, but what if it turns around? What if I missed the rocket ship? What if the geopolitical situation calms down tomorrow? Simon isn't a perma-bear, is he? What exactly would make him change his mind?
He is absolutely not a perma-bear. He's a realist. He trades what he sees on the chart, not what he thinks should happen. He has a very specific requirement to flip bullish. He needs to see a 5-wave impulse to the upside.
Okay, let's translate that. What does a 5-wave impulse look like for us on a chart?
It looks like undeniable strength. Real strength. It looks like the bulls clearly smashing through the sell walls, those massive blocks of sell orders sitting just above the current price. It's not just a little wick up. It's a sustained 5-step structure that breaks resistance and actually holds it.
And do we have that right now?
Simply put, no. Simon was very clear about this. Currently, we just have unconfirmed bullish divergence. We are oversold, yes. The RSI is low. But as Simon wisely noted in the update, oversold can always get more oversold.
Man, that is a terrifying sentence. Oversold can always get more oversold.
It's the hard truth that wipes out amateurs every cycle. Just because an indicator is low doesn't mean the market has to bounce immediately. It can drag along the bottom for days or even weeks while the price just keeps tanking. So the plan remains strictly defensive. Protect the short positions, wait for the 44K zone, or wait for that clear 5-wave impulse confirmation.
So until we see that specific signature of strength, we are keeping our shields up.
Shields up. We never guess the bottom. We patiently let the market prove to us that the bottom is in.
I really appreciate how this deep dive connects everything. We started with the news, which is just the noise, and realized it's mostly a distraction. The real story is always the underlying structure.
It's all about filtering the signal from the noise. The crowd, the retail traders, they lose because they trade on emotional bias. They see a scary headline and they panic. Or they see a green candle and they get greedy. The Paradise team wins because they trade on cold probability and patience.
And trust. That's the big thing for me. Listening to Simon, you really realize he isn't trying to sell you a dream. He's trying to protect what you already have. He's explicitly saying, I don't want you to lose money.
That level of care is rare in this space. He's acting as a custodian of the community's mindset. He's saying, look, I've done the math. The math says down. Let's not fight the math with our feelings. It's about longevity. He wants you to be here in 5 years, not washed out by next week.
Exactly. And if you are listening to this right now and realizing, wow, I have been trading with my feelings. I bought because of a tweet or I sold because of a scary headline. Don't beat yourself up. We've all been there. It is literally human nature. But you don't have to stay there.
No, you really don't. You can learn this. Simon mentions the MCP Free University on the My Crypto Paradise website. You can go learn the MCP3 strategy. You can learn to spot these triangles, count the waves, and identify the liquidity traps yourself. It is completely free. They're literally giving you the playbook.
Stop gambling, start learning. That is the motto.
It is the only way to survive long term. If you treat this market like a casino, the house will eventually take all your chips. If you treat it like a business, you can build generational wealth.
So here is the provocative question we want to leave you with today. It's a tough one, but you need to answer it honestly for yourself. Are you trading what you feel is happening based on news, fear, or hope? Or are you trading what the probabilities prove is happening?
Because the market does not care about your feelings. It will run you over without a second thought, but it always, always respects the probabilities.
Trade safe. Trade with the strategy. This is My Crypto Paradise. We'll see you in the next deep dive.